Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 11th of May. Let's dive into the week's top market news. European markets amid trade tensions and inflationary signals. The weekly wrap-up. The recently concluded week for European equity markets was characterized by marked volatility, ending with modest but significant gains in local currency terms. The Pan-European Stocks Europe 600 index reflected an initially positive sentiment, fueled by the easing of geopolitical tensions in the Middle East and a generally solid corporate earnings season. However, this initial optimism experienced a setback toward the end of the week. Weighing on the markets were statements from U.S. President Donald Trump regarding the threat of imposing significantly higher tariffs on European Union exports if the bloc does not eliminate tariffs on U.S. manufactured goods. The performance of major national indices proved to be quite heterogeneous. Italy's FTSE/MIB stood out as the best performer among the major indices, recording a robust rise of 2.16%. Germany's DAX showed marginal resilience, closing with a fractional increase of 0.19%, while France's CAC 40 remained largely unchanged. Conversely, the UK's FTSE 100 posted the weakest performance with a decline of 1.26%, during a week that was also affected by the closure of the London Stock Exchange on May 4th for a bank holiday. On the macroeconomic front, the European Central Bank, ECB, has sent signals of a potential tightening of monetary policy. Joachim Nagel, president of the Deutsche Bundesbank, indicated that an interest rate hike at the upcoming June meeting is highly likely. Such a move appears necessary unless a substantial and sustained improvement in the inflation outlook materializes. Confirming the underlying pressure on prices, Eurostat data revealed that Eurozone producer price inflation accelerated in March by 3.4% on a month-over-month basis and 2.1% year-over-year. This represents the highest monthly increase since August 2022, primarily driven by a sharp surge in energy costs. Despite these inflationary pressures, industrial activity across the region is showing signs of resilience, albeit with some mixed underlying signals. In Germany, factory orders in March surprised on the upside with a 5.0% jump, significantly exceeding the 1.0% consensus expectation. This growth was broad-based across machinery, electrical equipment, and data processing. Conversely, the German construction sector is experiencing a critical phase, with the S&P Global Purchasing Managers' Index, PMI, dropping to 42.1, its lowest level since March of the previous year. Meanwhile, industrial production in Spain returned to growth, expanding by 1.8% year-over-year in March, largely driven by the consumer goods sector. Finally, the S&P Global UK Composite PMI rose to 52.6 in April, up from 50.3 in March, indicating a renewed expansion phase in both manufacturing output and services activity. Now our insight into alternative markets. Navigating pipes in Europe, a strategic imperative. In recent years, characterized by particularly complex market and financing conditions, many European listed companies have found themselves needing to seek new sources of liquidity. In this context, private investments in public equity, known by the acronym PIPE, have proven to be an extremely valid solution for many issuers. But what exactly are they? We are talking about the issuance of shares or other financial instruments to private investors, often offered at a discounted price. This type of transaction allows companies to raise capital much faster and at significantly lower costs compared to a traditional public offering or standard private placement. It is a crucial advantage, especially when markets are volatile or unfavorable. However, executing a PIPE transaction in Europe is not a standardized endeavor because these transactions have a very strong local flavor. To complete them successfully, it is essential to carefully navigate the specific legal and regulatory regimes of the country where the issuing company resides, thoroughly understanding the local governance dynamics. So let's see how the rules of the game change in the main European markets, starting from the most recent legal and financial practices. Let's start with the United Kingdom. Historically, the strict British preemption rights system has always represented an obstacle for PIPE transactions. Recently, however, regulations have been streamlined to favor these investments. Today, a company can issue up to 10% of its share capital without having to ask for further shareholder approval, provided there are pre-existing authorizations. It is even possible to issue an additional 10% if the funds are used to finance a specific capital investment or an acquisition made in the past 12 months. This is a nice leap in flexibility, considering that before November 2022 these limits were capped at 5%. There are, however, important boundaries to respect. If the investor crosses the 30% voting rights threshold, a mandatory takeover bid is automatically triggered unless a formal waiver is obtained from the competent authorities. Furthermore, if the transaction involves 20% or more of the capital, it becomes mandatory to draft a full prospectus. Moving to Germany, the scenario changes and is closely tied to strict corporate procedures for capital increases. Issuing new shares, in fact, almost always requires a resolution from the General Assembly. German law dictates that the standard issuance of shares for cash contributions, excluding subscription rights, cannot exceed 10% of the share capital. There are strict rules on pricing as well. New shares cannot be sold at an excessive discount compared to the market. Generally, this discount stops at a modest 3 to 5% below the last closing price. An interesting trend we are observing recently in the German market is the strategic use of PIPE transactions in combination with mergers and acquisitions. And in France, the French market adopts yet different mechanisms, primarily based on reserved capital increases. French PIPEs are usually aimed at specific individuals or well-defined categories of investors. This procedure requires shareholder approval with a qualified two-thirds majority, which entails the waiver of preemption rights by existing shareholders. Then there is a very stringent rule on the value of the shares. If the placement exceeds 10% of the share capital, the selling price is not free. French law actually dictates that the maximum discount cannot exceed 10% of the volume-weighted average price recorded over the last 3 trading days. And, just as in the UK, in France too, if an investor crosses the 30% threshold, the obligation for a mandatory takeover bid is triggered, although it is possible to request a prior waiver from the Financial Market Supervisory Authority, especially in situations of corporate distress. Beyond the regulatory differences between the various countries, there is a crucial aspect that unites all these operations: the negotiation phase. For investors, participating in a PIPE does not just mean investing capital, but also securing direct influence over corporate decisions. This is why negotiations almost never stop just at the price issue. On one hand, investors demand strong governance rights. They want to be able to appoint their own representatives to the board of directors and secure voting or veto rights on decisive corporate choices, such as issuing new debt or future M&A operations. On the other hand, issuing companies do not just stand by and watch. They try to protect themselves by negotiating solid protection clauses. Prominent among these are standstill provisions, which prevent the investor from attempting hostile takeovers by acquiring too much control, and lock-up agreements, which prohibit the short-term sale of shares to avoid speculation and ensure stability to the share capital. In conclusion, while it is true that challenging macroeconomic conditions are increasingly pushing companies to seek new liquidity, structuring a PIPE transaction in Europe requires true tailored craftsmanship. It is absolutely essential to know how to adapt with extreme precision to the governance rules, the rigorous issuance limits, and the strict discount thresholds dictated by individual national regulations.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.